Consumers are accelerating their borrowing.
There will be some headwinds.
Student loans.
The consumer is going to come under increasing pressure.
Inflation, food prices, oil prices.
There are a bunch of debts coming due.
Rates start to materially weigh on consumer activity.
It's how consumers behave, not what they say.
Retail sales surprising to the upside. Joining us now to discuss is BlackRock's Amanda Lynham, Morgan Stanley's Michael Kushner. Amanda, first to you. Bit of a sell-off again in the Treasury market. A 2-year briefly through 5%, a 10-year at about 4.23. Can we start with the data, Amanda? What did you make of that 30 minutes ago?
Yeah. Good morning, Jonathan. Thank you for having me. I think it kind of reinforces this resilient economic backdrop that we've been seeing for quite some time. And I think the major read-through for corporate credit investors is what does this mean for Fed policy and how long we stay in this restrictive territory? And so it's really less about what is the ultimate terminal rate, but more about does this resilient economic backdrop leave the Fed in a position where the bar for rate cuts is very high and they hold at this restrictive, tight monetary policy environment for a while. And that certainly has implications for the higher cost of capital environment that we've been expecting in the corporate credit market for some time.
Michael Kushner, let's build on that. What are the factors behind this resilient U.S. consumer? And are they expected to fade anytime soon?
Well, I think it still comes down to that underlying story that coming into the rate hiking cycle, the household sector in general had hunkered down with refinancing their mortgage rates to, probably well below 3% for many people, and corporate consumer cash flows are pretty good. Interest rates go up on savings, and mortgage rates on liabilities don't go up, and you're aggregate okay. Of course, for certain sectors of the household sector who rent instead of buy, it's bad. And what's happened is not good for all households, but by and large, with nominal wage growth as fast as it is, and increasingly real wage growth as inflation falls, the household sector, again, in aggregate, looks pretty solid. And even with savings diminishing, there's no real stresses on them yet. With the unemployment way it is, job growth is 200,000 approximately per month, which was the average was the previous decade before the pandemic. Why should the consumer be too stressed?
Let's build on this then, Amanda. Is good data bad news for credit based on what you said?
I think to a certain extent it can be if we have this environment where inflation is showing improvement, but the economy is still strong, unemployment is still low, the labor market in general is still pretty tight. I think it removes a sense of urgency for the Fed to normalize policy quickly, and that certainly will have implications for corporate credit. I mean, we're already seeing it now. I would point to the Moody's default data that we received overnight. We're seeing an ongoing dislocation between the leveraged loan default rate and the high yield bond default rate, meaning the leveraged loan default rate is outpacing and continues to outpace the high yield bond default rate. And it feeds into exactly what we've been discussing, which is this higher cost of capital environment. The only distinction really between the leveraged loan universe and the high yield bond universe as it relates to that point is that those higher costs of debt are flowing through immediately for loan borrowers, but it's taking some time for the high yield bond universe for that to flow through. So to your question, if we stay in this higher cost of capital environment over time and we move closer to those maturity walls, that will eventually flow through. One of the questions we get asked a lot is, why is this not showing up in high yield spreads at the moment? And the reason is high yield borrowers, by and large, have the luxury of being patient at the moment. They've done so much refinancing, so much proactive liquidity raising in 2020 and 2021 that they don't need to act just yet. So they can still be patient, but it's only a matter of time before we get closer to that maturity wall, and I think that will flow through. Now, when you look at the corporate credit market, and Michael alluded to the dispersion that you're seeing at the consumer level, there's a lot of dispersion that's happening at the corporate credit level. So if you take that index level of 375 basis points of OAS in the high yield bond market, that in and of itself is tight. But if you look under the surface, half of that universe is actually trading below 300. So there's significant dispersion between the haves and the have-nots, and that's true within high yield, between high yield and loans. Certainly, as you get up into the investment grade landscape, it's a bit more resilient. But it's going to be a name of dispersion, I think, as we move through the next 12 to 18 months, and I think that will be key for corporate credit investors.
Amanda, could you frame for us just how painful that maturity wall might be? Let's pretend it's a month away. What's the difference between the coupon they're paying on existing debt and what they'd have to borrow at today?
Yeah, it's a great question. So I think the most instructive way to conceptualize that is to look at some of the sectors. At the index level, that differential is around 200 basis points. But for certain sectors, it's upwards of 300, 400 basis points or more. Now, we know that in practice, sectors don't issue debt, companies issue debt. But for some of those sectors that are facing, I would say, a combination of limited pricing power, secular headwinds, ongoing idiosyncratic risks, those mark-to-markets in the cost of debt will be significant. Now, corporates can offset that to some degree. They can issue less size. They could be strategic about parts of the curve that they target. They can try to be as opportunistic as they can about timing. But we do think that as that maturity wall moves closer, it will become a major story for corporate credit investors. And I think importantly, it's not just the 2025 maturity wall. It actually doesn't let up until 2029 in the U.S. high-yield bond market. So there's a significant quantum of debt that needs to be refinanced. And of course, we're coming off of record low supply years in 2022 and so far year to date, and record low coupons owing, of course, to the activity of 2020 and 2021.
Michael, what's interesting about what Amanda just said is so much of this is known to some extent. We have some insight, some clarity on this. We know where the maturity wall is. What I'm trying to understand, Michael, is when do we start to worry about it?
I think it's by the middle of next year. By the middle of next year, we should see, for sure, a slowdown in the economy and the Fed able to bring down interest rates and maybe bring down the whole term structure of interest rates. But if some things have changed so fundamentally that real interest rates, the final term interest rate the Fed's talking about, I think one of the big risks for the Fed in the second half or the fourth quarter of the year is that they don't change monetary policy, but they say, actually, that 2.5%, final terminal Fed funds rate, maybe it's 3.5%. And the rate cuts you can expect are much lower because the demand for capital, the underlying strength in the economy is strong enough to generate that strong growth. And it may be very uneven in who benefits and who loses from that. So by next year, we should see in terms of who's benefiting, who's losing, and how much the Fed will give relief to what's going on. That'll depend critically on the inflation rate and to a lesser degree on the unemployment rate.
Amanda, is that the source of comfort right now, that this is a problem out there in the distance, and before we get there, the Fed's going to be cutting rates?
As you know, Jonathan, we think the bar for rate cuts is very high. So I don't think that near-term rate cuts in the U.S. are a likely outcome from here. Taking your question specifically on timing, if we just look at the math of it, the 2025 maturity wall is really what we're focusing on in terms of the beginning of those refinancing needs. We know that high-yield corporates in particular don't like to let their debt become current. So it's reasonable to think that they will start to address that 12 months or more before those maturity dates to avoid that situation. So I don't think it's that far off in the distance. I think really what this hinges on is the unemployment rate, the backdrop of economic resilience, and is there urgency from monetary policy officials to normalize rates. I think, we'll look towards the Jackson Hole Symposium for color on kind of the duration of how long we stay in this restrictive territory. But I don't think, and this is very consistent with our colleagues in the BlackRock Investment Institute, that the Fed in particular is coming to the rescue anytime soon from this higher cost of capital environment.
Equities this morning, 20 minutes out from the opening, bout down here by 0.6% on the S&P 500. In the bond market, retail sales pretty strong relative to expectations. Yields were higher, through 5% at the front end on a 2-year. Backed away since then, down about 2 basis points on a session now to about 4.95 on a 10-year. They were much higher, through 4.23, 4.26 briefly. Back down just sub 4.20 at the moment at 4.19.92. Joining us now is Bloomberg's Ira Jersey to break down the data from about 40 minutes ago. Ira, what did you make of that?
Yeah, so clearly the consumer is pretty strong. They like lower prices. We have to remember that even though inflation, and based on the CPI report that we received last week, it was generally still not in the Fed's comfort zone, goods prices were actually a little bit lower. So I think it just shows the propensity of the consumer to continue to purchase goods when goods prices aren't going up significantly. So I do think the data is better. I think that the big thing that we have to take away from this from a monetary policy perspective is not does the Fed necessarily hike more, but how long do they keep interest rates where they are now? So if the market starts to price out some of the cuts from that are being priced for next year, that's as good as a hike in terms of financial conditions.
We've said it a few times. It's not just how high, it's how long. Ira, thank you, sir. Michael Kushner, Amanda mentioned the Fed and Jackson Hole next week. We're expecting to hear from Chairman Powell. Michael, what would you expect to hear from him?
I think it's a bit complicated at the moment. We know the FOMC is a bit conflicted in terms of what they think we should do. Some members think we should hike rates further. Other things, we've done enough. We have to wait and see. Others think maybe we should have rate cuts if inflation continues to fall to keep real rates where they are. So you've got three different kind of views, at least, amongst the board. So we'll have to wait and see how that plays out. So I don't think Chairman Powell can deviate from the current situation where we're waiting for more data. We're data dependent, and there's nothing else that we can say at the moment until we get more data.
Michael Kushner, Amanda Lynham on the latest with the Federal Reserve and the latest on the data as well. They're going to stick with us. Equity futures right now on the S&P 500 negative here by, let's call it 0.5%, with some movers around the opening bell about 20 minutes away. Here's Abby.
And a bit of a risk-off mood as you're talking about, John, but one big cap tech stock that is super resilient, NVIDIA, after rallying 7% yesterday, and Morgan Stanley saying that the recent, and in my mind, stealth 15% drop from the July top offers an attractive point of entry, and I should say recent top. Who knows, there could be another one. B of A filing today, boosting their price target. They report, of course, next week. The stock up another 2%. JP Morgan down 1.4%, falling amid this risk-off mood. Plus, there's some continued chatter about banks getting downgraded. Even the best of the best is feeling that pinch today. And then Tesla, well off of its lows earlier, down more than 1%, now down about 0.5% after they have rolled out a new base model X and S, but with a price tag that is $10,000 cheaper. Speaking of being off the recent high, Tesla off 22% off of its July high, John.
Abby, thank you. On the latest, more on Tesla with Ed Ludlow in about 20 minutes from now. Coming up, China's surprise rate cut.
We're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. There is such an accumulation of different problems and challenges facing China's economy. It's not just one thing right now.
That conversation up next.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
we're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. We'll need to see more coming on fiscal, given an absence of demand coming from other parts of the economy. I think we'll need to see more measures to stabilize property, given the latest warning signs there. And we'll need to see more follow-through on these initial efforts to boost longer-term confidence.
Michael Hershon there of 22V Research weighing in on China's surprising rate cut. The PBOC unexpectedly cutting rates by the most since 2020 in hopes of bolstering an economy that's facing fresh headwinds from a worsening property slump and weakening consumer spending. Secretary Yellen acknowledging the risk of contagion, saying this: China's slowdown will have the largest impact on its Asian neighbours, but there will be some spillovers to the United States. The team coverage begins right now with Bloomberg's Kelly Nines and Tom Orlick joining us down in DC. Tom, just how bad are things down in China, and what can they do about it?
So what we've got right now, Jonathan, is a crystallization of risks for the Chinese economy. The property sector was already turning down, but repeated efforts by the government to put a floor under that downturn don't seem to have gained any traction. And now we have Country Garden, one of China's biggest private developers, apparently on the cusp of not being able to service its debts. Worse news, signs that that slump in the real estate sector are now spilling over into the financial sector, with one of China's biggest trust companies, one of China's biggest shadow banks, struggling to make its investors whole. All of that reflected in the July growth data, with industrial output, retail sales, fixed asset investment, all the big gauges of China's growth, missing expectations and pointing to a bleak second half. Well, the cavalry's on the way, but hasn't quite arrived yet. People's Bank of China cut interest rates by 15 basis points. Normally they move in 10 basis point increments, so 15 basis points is a signal, and there's a bit more oomph there than normal. Still, relative to the magnitude of the challenge which China is facing, and also relative to the enormous interest rate moves which we've seen from the Fed and the ECB and others as they battle inflation, 15 basis points really looks inadequate to the scale of the challenge. Expect substantially more stimulus from China in the days and weeks ahead as they attempt to put a floor under growth.
You're not alone. I've heard that plenty of times this morning already. Across the South Side, SocGen said this is unlikely to be the last measure. Katie, we actually heard from the Treasury Secretary acknowledging that this could be bad news for the US. To what extent could that be bad news?
Well, she did try to downplay this while acknowledging the risks, Jonathan. She said that she still feels good about U.S. economic prospects overall, while recognizing that China does indeed pose a risk factor. Of course, as the Treasury Secretary, former Federal Reserve Chair, she is not immune to the knowledge that anything that happens in the second largest economy and fragilities in it could have ripple effects around the rest of the world. She was, though, more careful in the selection of her words than, say, President Joe Biden last week, who at a donor event in Utah called the Chinese economy a ticking time bomb and said that they were in, quote, trouble. And that trouble is feeding through to the U.S. policy response to China as well. Of course, we have heard repeatedly from not just Secretary Yellen, but others in the administration saying that they are not intending to hold China back economically with some of their policies or decouple these two largest economies in the world, rather using narrow, specific, targeted things to protect national security.